What's up, everybody? Welcome to this week's episode of Hidden Forces with me, Demetri Kofinas. My guest for this episode is Brian Kelly. Brian is founder and CEO of BKCM LLC, an investment firm focused on digital currencies. He is the portfolio manager of the firm's Digital Asset Fund, a regular on-air contributor to CNBC, and the author of The Bitcoin Big Bang: How Alternative Currencies Are About to Change the World. Brian, welcome to Hidden Forces.
Thanks for having me. Great to be here.
Oh, it's good having you on. I also must say to the audience, this is the first time I have to say this, this is not financial advice. I don't know what the disclaimer is, the official disclaimer is on podcast. Maybe, Brian, you know, but I want to make sure that that's the case because with our episode on Ari Paul, I think we veered very close to that area, and I don't want to misrepresent anything. So this is not financial advice. Don't sue me.
Yeah, or me either. I'm happy to talk about crypto, but when people do invest, as with any other asset, they need to make sure they're doing their own research, make sure that they understand that this asset class is extremely volatile. We're early days, so this is not by any means financial advice. This is just simply my opinion about the crypto market.
So what were we talking about before? I wanted to ask you about your background. That is kind of my first question, but let's get right into that because I was telling you that I did some research for you before you came on. I knew that you'd be a sure bet because you're on air all the time at CNBC, but I heard about one podcast that you did. You said you've done like a couple, and I told you I think that you actually should do more because you don't hold back, you don't reserve, and you're talking. That's probably because you're not from media. So what's your background? How'd you get into media?
So my background is investing. I started as one of those annoying cold callers at Lehman Brothers back in the early 90s, and that was a horrible job and a wonderful job all at the same time. I learned an awful lot, but you're making 700 phone calls a day, and it's kind of mind-numbing. But I've been in and around.
That's got to be a brutal thing to do.
I was 19 years old when I started in college. It's brutal. You get a really thick skin from it, and you learn a lot about sales.
What are the worst things people have told you? Do you remember some of the worst things?
You know what? It's not really even that people say bad things. They just hang up on you. And this was the 90s, too.
That's
very different.
Late 90s?
Early 90s.
Early 90s.
Like 92 or so.
Okay.
And this was the big thing. And I was 19-year-old college kid.
That was coming right out of the recession.
Yeah. I was 19 years old. I saw these stockbrokers making all kinds of money by calling people on the phone, and I was just fascinated that, what was going on with it. I loved investments just from the get-go. I've just always been fascinated with it. And so to get into a job like that, I just wanted any job that I could get. And so I took this job. I did it for a summer and a little bit more after that. It was a great experience, but boy, I had two phones going at once. I dialed 700 phone calls a day.
Analog lines.
And, my job was only to get the person on the line. I couldn't pitch investments, couldn't do anything like that. So all I would do is dial. My job was to get the prospect on the line and then hand it off to a broker.
You're an Eskimo. You'd break the ice.
Yeah, exactly.
So what fascinated you about finance? I mean, that's interesting. That's an interesting thing to say. You always found it you found it fascinating.
You know what? Yeah, I've always just been curious about economics, finance. I've always just been, even when I was a little kid, I always was curious about incentive systems, right? How do you incentivize somebody to do a job that you might not want to do, right?
That's really interesting. That's kind of highbrow for how old were you when you think about incentives?
I was 3 years old. No.
That's pretty highbrow thought. That's a pretty philosophical,
well, I think
idea.
It's always fascinated me, right? What is an economic system? An economic system is we have all these jobs that need to be done, right? And some of us like to do some of us like to do other. But what's the incentive mechanism to get all these things done besides just pure pleasure or need, like I need food, I need water? But once you get above that level, why do I need my lawn mowed, right? I want my lawn mowed. So what's the mechanism to get either my lawn mowed by me or by somebody else? And to me, that's what the economic system is. And again, that goes even further into Bitcoin and digital currencies and why I found those so fascinating, because it's a new incentive system.
So we did an episode on the moral economy and behavioral economics and sort of incentives. It was with Sam Bowles, who's an economist, but it was really interesting because we took Hayek's work on the price mechanism and the information problem, and we sort of merged it with some of the work that Bowles and others have done with moral philosophers and moral philosophy and try to rethinking about incentives, and that's exactly correct. And in fact, that episode was popular among the crypto community in retrospect because of the fact that in particular with engineers, because it dealt with the issue of incentives, and that is so central in engineering,
right?
In sort of engineering these currencies. So tell me how you got into this space, right? So you're a guy now from Wall Street. You're kind of like a jock type, you know.
So I was a broker for a while. Then I was an equity trader. Then I started an institutional brokerage firm where we traded big blocks of stocks. As part of that process, I traded a lot of merger arb, risk arbitrage. That turned into, at the time, what was called cross-border arb or ADR arbitrage. So you're trading in foreign countries. IBM might be trading in Germany in the morning. It's mispriced versus the U.S. And so you've got to do the currency conversion, all that. That's how I fell in love with currencies. And to me, that's just pure economics and pure macroeconomics. So kind of segued into global macro investment strategy, ran a global macro fund for a number of years.
When did you start the fund?
Let's see this. So the strategy, I started in 2009 with that strategy, with the global macro strategy. Yeah.
You were like, some shit's going down.
Yeah.
Across the globe.
Yeah, exactly.
Something's happening.
Exactly. I need to be involved in this. So yeah, that's so I was doing that. And
what did you focus? Did you focus a lot on currencies?
On currencies, that's really my specialty.
That's your specialty. Yeah. What did you focus on? Which?
I mean, well, the major ones, but you know, so the G7 currencies mainly, and then interest rates after that. Stocks is kind of the last thing to me. When I look at the financial system, where you start to see the flows first are in the currency markets. So to me, that's the first mover. You start to see, you know, okay, money's moving into this country or moving into this asset class. And a lot of times you can see that in currency markets first. So that's what I thought was my edge. And that's kind of how I approach the financial markets as a whole.
It's super cool and interesting that that was your background and your focus was Forex, and then you got into Bitcoin. So let's talk about that, because you are an example. If we can sort of generalize about how different groups of people, demographics, backgrounds, psychographics, whatever, get into cryptocurrencies, because in your case, you kind of dipped your toe, but you didn't really do anything, and then you came back, right? Something like that. How did you get in? What was that sort of?
So around 2012, I read about Bitcoin. I think I stumbled on an article in the Financial Times or something like that. And my thought was, well, that's kind of cool, and that's really fun internet money for a bunch of geeks, and that's good luck to them. That's not going to work.
You're like those idiots.
Yeah, I'm like, that sounds fun, but there's not a shot this works. And so I ignored it, you know, and I thought, okay, let me just kind of keep an eye on it as a hobby.
Did you read the white paper at the time?
No, I didn't read the white paper.
Okay.
No, I did exactly what every other Wall Street person does. And I looked at it for 30 seconds and said, can't work. No way. Can't work, right? It's a currency, so it needs to have a government. It needs to have an army that backs it. You got to be able to pay taxes. All these preconceived misconceptions I had in my head. So it took about a year for me to break through all of those old kind of thoughts about what a currency is, what an economy is. And, you know, in that year, obviously, Bitcoin went from 30 to 150 or something like that. But in 2013 is when I really started to dig into it. I finally had that kind of aha moment that this is something special. And so ended up writing a book, which was published in 2014. And then since then, I've been investing in both the currencies and then companies in the space.
That's still pretty early. I mean, relative to the guys in your space and gals in your space.
Yeah.
Do you work with Josh Brown?
Josh Brown, I'm on CNBC with him.
Was Josh aware of it back then?
No. I don't. I mean, I'll tell you what. Josh has been,
because he had the Reform Broker. He had the blog for a very long time, so he was in the blogosphere world. I mean, he wasn't obviously on Reddit.
He's been aware of it, and actually, a friend of mine sent Josh, and this must have been maybe 2015 or 16. A friend of mine gave Josh some Bitcoin as a Christmas gift, just a little bit of dust, and I remember Josh and I talking about it then. So he was pretty early in it, but. Yeah, going back to 2013, 14, it was a very different landscape.
Right, very different.
There weren't a lot of financial people in it at all.
Yeah. So you wrote the book. Personally speaking, what were you doing in terms of investing? It sounds like you kind of touched, if I remember correctly from hearing a previous interview, you bought in close to one of the interim tops, and so then you kind of kicked yourself in the ass a little bit after, which is a good way to better to lose a small amount early than to lose a bunch later.
Right.
So that was a good lesson for you. And then during that period that it was going through a sort of a bear market, you wrote the book. That's when you wrote the book, right? Which is excellent. That sort of, in some ways, doesn't that also parallel the development of Ethereum and the utility protocols? Right.
So that was about that time where you started to get 2 and 3 other currencies. I mean, there was the Omni protocol, and you know there were probably 10 or 20 different currencies at the time. But yeah, to your point about when I first bought in, it was in the 600s, and I still didn't believe it. But I started my book off with this quote too: is, you know, I looked at this, said this thing is a bubble. It is going to be a huge bubble, but it's going to end in tears. It's not going to work. But guess what? I read a quote from George Soros, and he said, when I see a bubble, I buy in, because that's how I make money.
Yeah, completely.
So I was like, well, listen, I want to be George Soros. Yeah. He seemed to be he does pretty well. And so I bought in without knowing what it really was. And so it went from 600 to 1,200. I thought I was the greatest trader to walk the face of the earth. Went from 1,200.
Wait, what did you cost average in at?
About 600.
Oh,
so within a couple weeks, it doubled.
Oh,
and I thought, wow, this thing's going to the moon, everything. And I didn't really even know what I bought. And I really, it was one of those, let me go pick out what my private jet's going to look at, because in a couple weeks, I'm buying one. And then China decided to crack down on their banks for the first time, and it dropped. And I tell the story all the time. I made every mistake that I tell traders and investors not to make, right? I turned a trade into an investment. I didn't do my research. I didn't have any risk management. I did everything wrong about it. And I had this Bitcoin, which I didn't know what it was. And then I said, well, you know what? I own it. I better figure out what it is. And that's when I did my deep dive, and then it really hit me like, wait a second, this is something pretty special.
There's a similar analog story from our friend Jim Grant, who was on the show, which I've recited once before, and of course listeners who heard that episode will know it, but it refers to his experience buying gold at the peak in 1981. Yeah. And he goes, I physically stood in a queue to buy gold. He's like, and I learned on that day, Demetri, never stand in line to buy anything.
Very much. Absolutely.
So,
absolutely.
But of course, who was a bigger bull on gold than Jim? So he bought it at the peak, and yet, so that's sort of the parallel. One of the things that I've struggled with, and I think people struggle with in general, whether we're talking about data, backwards-looking data in order to make forward projections, which is something that we covered with Ari. And Ari made a good point, which is that in some ways, looking into the past, in many ways, can be detrimental towards investing. But separate from that, I mean more generally trying to understand the size and scope of this market, right? Everyone says, people have told me, go to CoinMarketCap, just go to CoinMarketCap, you see what prices are. How reliable is that data? Bitcoin's data, I'm sure, is more reliable than the data of Monero or whatever, all these other coins, I imagine. Or you tell me. What does this ecosystem look like? How do I get my sort of
So it's kind of interesting. What I find fascinating coming from the macroeconomic side of it is that all of these blockchains, for Bitcoin every 10 minutes, but for some of those other ones that have blocks that are less than a minute or a minute, you get this wealth of economic data. Every time a block is produced and processed, you get to know how many transactions were in there, what the value of it was, where it was sent to and from. So you just have this huge database of economic data about this ecosystem, right?
Reliable data that you wouldn't have anywhere else.
Don't get. It's a real-time report on the GDP.
Interesting.
Right? So it's every piece of data that we wait at 8:30 every morning in the stock market to find out about happens every 10 minutes in Bitcoin and less in some other currencies. So to me, that data is recorded in the blockchain. So you can extract that out. So that's the core data that's going on. When it comes to pricing is still a bit scattered because we have fragmented exchanges trading in multiple different currencies. There's a lot of friction.
Trading.
Yeah, thin trading, although these things trade pretty well.
Right, Bitcoin.
Yeah, most of the major currencies, particularly with Bitcoin, but they trade as much as the GLD ETF
well, let's
does.
separate. All right, so let's separate that, right? Because first of all, we're going to say tokens and currencies all together because they're all listed on CoinMarketCap, right? We've differentiated for the purposes of asset allocation or thinking about taxonomy on the show, but just in terms of the price quotes we're getting, how many tokens and currencies are listed on CoinMarketCap?
I think there's about 1,500 to 2,000.
Okay,
right now.
And if it's not listed on there, what does that mean? You shouldn't buy it.
Yeah, you probably shouldn't buy it. Listen, that's
like going to a burning theater.
Yeah, it's a blanket statement. But generally speaking, the better projects, the better currencies, tokens, or assets are listed on multiple exchanges, have reliable data on them. They have a website, right, and you can talk to the people. That's not to say there aren't some out that I might have missed, but generally speaking,
those are pretty dark pools.
Yeah, exactly.
Pretty
exactly.
Dark.
I generally stick in the top 20 to 50 coins listed on CoinMarketCap.
Okay, so within those 20 to 50 coins, all those 20 to 50 you think are sufficiently liquid?
Sufficiently liquid. It depends on how big your portfolio is, right? Mm-hmm. If you have $100,000 that you're investing in this as part of your portfolio, all of those coins are sufficiently liquid. You're not going to have any issue.
Mm-hmm. So then, okay, let's talk about that. So you kind of look at the top 20 to 50. That's sort of how you, because there's so much stuff to look out there. You got to look at all those white papers.
Right.
And that's another question I got for you, right? Now I had a whole rundown here. This happens sometimes with some guests where I literally just scratch the whole thing. So, you're a Forex guy. How much do you rely on technical trading, and how much do you rely on the fundamental analysis where you're actually going through the company, looking at the team, looking at the white paper, et cetera?
Yeah, I use every tool available, and I've always used every tool available to get an edge. So generally the way I look at it is technical analysis to me is really just looking at human fear and greed and where these extremes in human behavior are. And, you want to use Bollinger Bands, you want to use moving averages, whatever works for you.
How useful are those? How useful are those, and how useful are the tools, techniques?
I look at technicals as a map, right? So I look at it and say, okay, we are, here's all the technicals that are flashing red, right? Okay, this might be a turning point. This is a point where a corner is coming. And so then I look around the landscape and say, okay, fundamentally, where are we? For Bitcoin, for example, and for quite a few of them, we have an internal model that tells us what the fair value is based on number of transactions, velocity, and stuff like that. So I'll go and let's just say, give you an example, right? Bitcoin's trading at somewhere around 11,000 right now. And I don't have the numbers on me exactly, but let's say my internal model says the fair value for Bitcoin's 9,000. We're at 11,000. We've had quite a run. We're up against multiple different technical indicators. That might be a point where I'll say, hey, you know what? We're above my fundamental fair value. We've now hit technical points where it might be a good time for this market to turn. People are getting really excited about it. Sentiment's very high. Let me sell some. That's kind of how I think about the process.
How do you calculate fair value for, let's say, Bitcoin?
Yeah, in Bitcoin in particular, our model has about 4 or 5 different inputs, but the biggest ones are velocity of money, so how much the money's turning around, the number of transactions. My model is inspired by Metcalfe's law, which is the rule or the how do you figure out what the value of a network is, right? And it was designed back in, I think it was the 70s or 80s for telecommunication networks. So that's number of nodes squared gives you Metcalfe's law, what a network is worth. I plug in transactions, so number of transactions squared. And if you do that, you throw some velocity in there, do a regression on the price of Bitcoin, you come out with a fair value. And that's how I look at it. And, to really get it super simple, the one way to think about it is, every quarter when we look at Facebook or Twitter's earnings, we ask what are their monthly average users, MAUs, right? How much engagement is there? I think transactions on the Bitcoin network or any of these currencies is like MAUs. How much are people using this thing? Do people want to use it at all? That's kind of a comparison metric, if you will.
So that touches on a few things. One is about how much people are using it, the question of adoption. I am curious, because you work in media and because so many of your colleagues are from the financial industry, how have sort of institutional investors and how do you feel the public, two, I think, demographics that you're uniquely qualified to talk about, have adopted this, and how do you feel that they may continue to adopt it, and what are the risks to sort of dissuading people from actually getting into it in a significant way? One of, for example, is exchange risk, which we're kind of getting into there.
Right. So it's kind of interesting because this asset class has been adopted as an investment by the general public way ahead of the institutions. First time, absolutely. Usually that's the sell signal, right? Joe Public comes in, that's your sell signal. But it's not the case here. Yeah. And I can tell you the conversations that I've had, almost every major institution in the world is looking at this seriously now and looking to allocate capital to this space. So that's on the investment side. On the actual use case side, Bitcoin is finding its use cases, right? Earlier it was the dark web. That is not so much of the case anymore. But now it's starting to be used in cross-border trade. People are settling. You do it. If you're in Brazil and you're doing a transaction in China, instead of getting a letter of credit and waiting a week for your money to transact, people are just sending Bitcoin. 10 minutes later, you get your money. So it's finding where it needs to be.
How much of that business is moving to Bitcoin? Because I would be concerned about the volatility in the market to do any kind of sort of significant business with it.
Yeah, but actually it's increasing. It's not a huge portion of the transactions today. But in terms of the volatility, you just pick a US dollar amount or a Brazilian real amount, right? So we say, if I'm in Brazil, we're doing business with China, we say, here's the value we want to exchange. Okay, at this point in time, here's the Bitcoin. There's plenty of payment processors that will give you a 10-minute window and guarantee you a price.
Oh, I see. Okay, cool. All right. So Going back to my point about exchange risk, and you were talking about fundamentals, one of the things, variables that's in there, regardless of Metcalfe's law or velocity or anything else, are these existential risk factors. Mm-hmm. One of which is, your exchange being hacked. Another one is government regulation, right? Mm-hmm. Those two and any other, how do you incorporate those events, those risks in your models? And sort of in the wider picture, how do you incorporate them? Like, what would be like a big sell signal, like for the, intermediate long term? And then also just on a sort of trading basis, how do you trade around them?
So in terms of those are very almost impossible to model, right? So you just have to have risk mitigation, So in terms of exchanges, we rarely leave any coins at exchanges. Our procedures are within 24 hours, we get everything off that we can.
And you put it in cold storage.
And put it in cold storage.
How do you do that?
How do we put it in cold storage?
I know. Yeah. Explain to me and to our audience, what is your sort of process with that?
So the process is, once we've done a trade on an exchange or with an OTC broker, it is sent directly to our cold storage wallet. I don't touch it. Nobody else in my firm touches it. It goes right to our third-party custodian.
So they get it digitally, and then they put it in a hard drive, and they put it off the internet.
Exactly.
That's so interesting. And do you actually go and do physical audits of the hard drives? Ever? Because it's just like, it's very comparable in many ways to taking physical delivery of gold.
Right. Absolutely.
And you do physical audits at bullion banks.
Right.
I'm just curious.
So we use an SEC qualified custodian for this. So they are audited by the SEC, and this is kind of an institutional level of custody. If you're an individual out there and you're doing it, I would suggest just using your own cold storage.
Right.
You can get devices called Ledger or Trezor, and you can basically put it on. It's a thumb drive, effectively. You put it on there and you put it in a safe. And that for the individual is probably okay.
Mm-hmm. So this is interesting. I touched on it myself. We were going to get into it later, but we can jump ahead to it. And that has to do with gold, right? This is really fascinating. It's fascinating. What do I mean? There's such an interesting crossover and then also hostility. It's almost like Mets versus Yankees or something. They're like Islanders versus Rangers.
Right.
It's like there's this sort of fraternal hatred and also competition, and yet there's the common creed of the Bitcoin and gold community. Some people that have been self-subscribed, or others would call them gold bugs, have been early adopters of Bitcoin. Others have and remain hostile to it. Mm-hmm. Just an interesting sort of culturally speaking, again, one of the things that I think you're qualified to talk on is because you work in media, you get so much exposure of this stuff, guests coming in, producers, professionals. What is the culture of particularly Bitcoin and gold, and what's that crossover, and how does that whole thing work?
It's a great, I'm glad you brought that up, because the Bitcoin gold kind of battle, if you will, it really shows the generational rift that's out there. And I've said on TV before, if you are a baby boomer, you buy gold. If you're a millennial, you buy Bitcoin. Mm-hmm. And that's really the shift, right? And guys like me that, I'm in my 40s, right? We're kind of caught in the middle. And, I feel fortunate because I have the experience enough to trade in this asset class, but I'm not entrenched in my ways enough to say, well, gold is the only way to go. So, yeah, it is really this divide. And the gold bugs will tell you, okay, great. Well, if we lose electricity, then how are you going to move your Bitcoin around? And that's a very fair point. Although if I'm walking around the world shaving off ounces of gold to pay for food, there's other things that I'm worried about at this point in time. So secondarily, the Bitcoin people will tell you, well, there's plenty of ways to have a network that we can operate, and Bitcoin's more useful today, right? There's 100 to 200,000 stores that you can buy something with Bitcoin on. There's none that I know of that you can buy something with gold. So, there are benefits to both. What I say to people is just buy both. If you're worried about it, just buy both.
So a few things. One, neither gold nor Bitcoin, yes, people will say gold has intrinsic value. One big difference between Bitcoin and gold is gold actually has industrial use cases. But let's put that aside. Really, what we're talking about here is what is the value proposition for owning this asset? And I think the value proposition for both is similar. For really owning it for non-industrial use cases, which is you're buying it as a hedge against, I think, financial market risk or credit risk in systemic risk. Like you're looking to get outside the financial system.
Right.
And the only, I think, value to owning gold is to own physical gold. I've always thought that. I've always been of that mindset. And I have the same sense on Bitcoin as well, which is that you can certainly make a ton of money speculating on it. And I want to talk about that. And we can talk about cash-settled futures too, because I want to know if you're trading them, sort of how useful that is as a hedge against your long positions in physical or whatever else, and what the correlation between the cash-settled and physical markets are. I'm curious. But when I first started to delve into blockchain in late Actually, it's not even really fair to say late 2012. It's more fair to say early 2013. The thing that I thought was sort of most obvious is, well, why wouldn't someone create a blockchain ledger that is attached to sort of gold, like, some kind of like gold blockchain currency? I looked around before this interview, and there are some companies that do that. I wonder, A, what do you think about that? This idea, because of course this goes back to my point, which is that one of the really great things about gold is that it's a physical asset. It has 5,000 plus years of network effects. There are many people around the world that will look at you like you're nuts if you want to take Bitcoin over gold, So, but at the same time, it's so difficult to account for it. It's very costly to move it. Auditing it is very difficult. Putting a paper trail around your gold on a blockchain seems to me like an incredible sort of, value add. Tell me what you think about that.
Yeah, I would disagree with that.
Yeah, okay.
And it's because I've tried it. I went and said, okay, let me take a digital currency and try to back it with gold. The issue that you run into is you ultimately have to trust that somebody's holding your gold. So you still have this trust problem, which is exactly what Bitcoin solved, is the problem of trust.
Right.
And the Royal Mint is doing it. They're probably the most trustworthy out there. But again, if I'm holding a gold-backed digital currency and I want to get my gold, I still have to go to a third party and say, please, sir, can I have my gold?
Right.
And you have to trust that it's there and that's audited and all of that. An interesting thought experiment, and it was brought up by Bobby Lee of Moby, and he used to be BTCC, is that his contention is that Bitcoin shouldn't be backed by anything, because as soon as it is, you then have to trust that third party. And because this is a trustless system, anytime you insert an element of trust, you destroy the value of the digital currency. It's an interesting thought experiment. But in terms of, backing it with gold, it sounds okay, but the only way there's no way to do it without having that trusted third party. And then, I'm not sure what the value of having a digital currency. I mean, you can have, the Royal Mint is doing a digital representation of your gold certificate. That might be helpful.
That's kind of what I mean. What I'm really saying is adding value to the existing stock of gold and to your own particular bullion bank's operation or your mint or whatever.
It probably adds more value to gold because you're adding liquidity.
Right.
That's probably what it does.
And accounting too. I mean, you think, because still you have to, well, you still need to audit it, but
you still need to audit it. I'm not sure.
Transfer, I guess. Maybe not accounting is the wrong word. Easier to transfer. Easier.
That's what I'm saying.
It makes it more liquid.
Right, if you have a bar of gold in the Royal Mint, and now I have a digital certificate, a digital token that represents it, and then somebody at the store down the street wants to take it, then I've got liquidity. But your point being is that you're still saddled with the problem of a third party verification, and that it's there.
Interesting point.
Right.
So then let's talk about the technology, right? Because this is an appropriate moment to speak about the tech. What is your sense of makes you most bullish about, let's say, Bitcoin specifically, how you differentiate between Bitcoin and Ethereum, these utility protocols? You talked about velocity. That plays a role in that in that calculation. And then also, what do you think the biggest challenges are to these currencies being adopted, technologically speaking? And I'm particularly talking about the problem of scalability and being able to actually use these currencies for real-world operations, or more importantly, the utility protocols, right? And the dApps that are being built on top of that.
Right. So in general, when I look at the space, I'm making a bet on digital currencies and digital assets as a class. I don't know if Bitcoin will be the one. It has a massive lead. It has all the network effect. I get the arguments of why it should be the leader, but I remind myself every day that MySpace existed well before Facebook. MySpace had that network effect, right? Yahoo and Netscape all existed before Google was even invented. So the history of tech tells you that it disrupts itself. So I want to make a bet on the entire ecosystem rather than a specific currency. I ultimately think that we'll probably end up with 10 or 20 kind of core protocols that will operate the digital economy. And by what I mean by that is, you say, okay, if I am in Brazil and I'm using Bitcoin to send to China to settle a contract, to settle a international contract that we've done, maybe I ship some iron ore to China. It solves a problem by sending Bitcoin. But then what legal system do I use, right? What's the global legal system? Well, maybe Ethereum plays a role in that, right? And I can write the smart contract. But, what if we have a dispute? We're human beings. I know it's immutable, but we're human beings. What if we have a dispute? Well, now I need some sort of judicial system, maybe one of these governance coins. And so I look at the real economy and say, what needs to be replicated in the digital economy? And, then I say, these protocols that are replicating the real economy are probably the 10 or 20 that are going to stick around for a while, or at least the concept of them. So that's how I look at the space in that terms. In terms of scalability, it's being solved. People are working very hard on it, and I think this year will be the year of scalability.
Let's talk about that. That's a very interesting definitive, not a definitive statement. What is it called? You put your
pounding
flag.
the table? Yeah.
All right, but so that's interesting. What gives you confidence that, well, first of all, why do you say it's being solved? Who's solving it in your view? How are they solving it? And why are you so confident that we're going to have it solved this year?
Well, a couple things, because we've seen atomic swaps already, and that's
Can you explain what that is?
Yeah, it's effectively you're transferring coins between chain. To me, the idea of scaling on a single blockchain, so Bitcoin, for example, is better solved if I can use multiple different currencies connected together. So almost like the internet of blockchains, right? And so each of these particular coins have their own feature. You want really fast payments, you use one particular coin. You want a smart contract, you use another particular coin. And they all have to interact together. And to me, just like the internet did, that's how you get scalability, rather than trying to take one particular blockchain and scale that. So
that's a good, interesting point.
That's how I look at the scalability issue. So why is it being solved? So you've got atomic swaps, which allow you to move coins from one chain to another. Technological way to do it. One that I'm an investor in is Cosmos, and that should be coming out in the next month or so. And what they are literally calling themselves the Internet of Blockchains. But they have kind of a hub system where anybody can spin up a Bitcoin hub, an Ethereum hub within the Cosmos blockchain. And what the Cosmos blockchain is just keeps track of all the coins. And so that's an infinitely scalable solution.
How deep do you get into the technicals? How deep do you get into the weeds? And
Yeah, so I get fairly deep. I'm a finance guy, though. I'm never going to be the coder, so that's why I have a CTO. His job is to dig into it. And then if we have questions, we have third-party auditors and stuff like that. I'll go through it. So, I understand the tech. I'm certainly not a coder by any means. But for me, when I look at it and say, okay, does this solve a real problem in the space? I rely on my CTO to tell me whether these guys and gals that are doing it actually have the technical chops to do it. And then, we'll dig in as deep as we need to dig into it.
Mm-hmm. Let's go back to the futures market. We're talking about futures, cash settled versus physical.
Yep.
How are these CBOE and CME, they launched in late 2017.
Yep.
How has the trading gone on the futures exchanges, and how useful have you found those as actual hedges against long positions in physical?
Yeah, so just for full disclosure, I'm on the CME's board of advisors for their futures, just so people know that. They started, I actually thought the launch was a home run because people talked about Bitcoin futures blowing up the market. There'd be no liquidity, there'd be none of this. It's traded very well. And in the first days, we had massive volatility in Bitcoin. So I think both the CBOE and the CME have done a masterful job on the launch. Liquidity is improving. It's not quite there yet, at least for an institutional level. Part of that is because not a lot of futures commissions merchants, FCMs, are allowing you to trade these, right? So, and the ones that are, you're putting up 50%, 80% margin. So as people become less frightened and understand the product, I think liquidity will improve. To me, it is a game changer for institutions because one of the biggest hurdles that institutions have is custody of these assets. And so with futures, they've already got futures custody. They've already got a futures broker.
Because they're also cash settled. They don't need to worry about that.
They don't need to worry about the custody at all. So they're getting better. It's a necessary part of growing the ecosystem.
Is it unfair to say that the only real connection it has to Bitcoin is that it's using it as a sort of an anchor for its own price? But ultimately, there is no real actual... I mean, you could say that the Bitcoin cash-settled futures are not Bitcoin in any way whatsoever. But they are a way that institutional investors and retail investors who are hesitant to get into a sort of wildcat banking era type asset can get sort of an opportunity to bet against each other, basically, in a different market.
Yeah, I don't know if it's fair to say they don't have any tie to Bitcoin, because ultimately they do, even though they are cash settled. I mean, we are still making an agreement that at some point in time, I will pay you based on the price of Bitcoin, right?
Right.
And so, as a market maker, what the market maker is going to do, if you come in to buy Bitcoin futures and I sell it short, I have two choices. I can either buy the futures or I can go and buy physical, right? And I can hedge my position that way. So, just like any of the other markets out there, there's plenty of markets that aren't really tied to the physical. I mean, would it be great to have a physically settled futures market? Absolutely.
Yeah, I mean, we have the same thing in cash-settled gold futures.
Yeah.
But the point I've made before that I think, and I made this point with Chris Burniske on our episode, is there's a type of, for me, there's a sort of a bastardization, and that's not a judgment of it at all. I understand why it's happening, but there's an irony in creating a cash-settled futures for a digital asset, a natively digital asset. You know what I mean? That's all. But I do understand why it's happening. So you're talking about the price, and it is a derivative. So how is the CME and the CBOE, how are they formulating their price? I've looked at some of the documentation. They differ in how they do it. I think CME uses more exchanges than CBOE.
Right.
How does that work? What's the do you know?
So as far as I know, the CBOE is based on the Gemini closing price, which is the Winklevoss twins exchange. The CME is based on a index developed by Crypto Facilities out of the UK, and it's multiple exchanges. I think there's benefits and negatives to both. To me, the benefit of using an index, though, is that we do have price differentials on multiple exchanges, and there's still a lot of friction in this market where you can't get accounts opened at all the exchanges, so you do have some price discrepancies. So kind of blending it together, to me, gives you more of a true global price of Bitcoin. I think everybody in this space, they want to have the benchmark index, right? Everybody wants the S&P 500, and they're all fighting for it. So having a futures based on your index is pretty good.
It's incredible to see how the space has been financialized so quickly. There's never been an asset that's been financialized this quickly.
Yeah, it's even shocked me. I mean, I thought we were 3 to 5 years away from that type of thing.
Yeah.
And it's really happened very quickly, and people joke in the space, it's Bitcoin time. Bitcoin time is sped up. No, it's really this year. With my fund in the beginning of the year, people would call me and say, I'd like to invest in Bitcoin. And I say, well, our fund invests in the top 20 to 50 currencies. And they said, what? Wait, there's more than one Bitcoin?
Oh,
and that was what the institutional mindset was at that point in time.
So how did this person call you and not have that information? I wonder. So that goes back to my point, right? How people are, how they're learning about the space, and then how they're actually working up the sort of resolve to jump in and all that sort of stuff. I mean, what is that on a qualitative level? What is that process that you're seeing from people? Like, what are we talking about here?
So, I mean, some of the people are just like everybody else. You watch this asset, you think it's not going to work, you think it's going to fail, and then you just can't kill it. And
so many people have made so much money. That's
the other part, right?
That is the part. That's it. That's all.
So I was trying to be, very intellectual about it, and but really the interest came when Ethereum went to 7 to 400, right? And you see your neighbor driving a new Ferrari, and you say, well, geez, he's dumber than I am. I got to be able to make something off of this. So that's where the real interest comes. And then, just like any other asset class, there are some people that come in and do a ton of research, and there's other people that just want to buy the next hot thing, and that's a personal choice. Let's call it that.
They're action guys.
Yeah.
So what about ETFs and ETNs? There are, as far as I understand, there are no Bitcoin or crypto public ledger-based ETFs or ETNs in the space. There are blockchain-based ETFs. What are those blockchain ones? And then why are there no Bitcoin or cryptocurrency ones? And do you expect to see any?
So in the U.S., there are no Bitcoin cryptocurrency ETFs. You can get exposure that way through the Bitcoin Investment Trust and the other products that Grayscale have. I don't expect a cryptocurrency ETF this year.
The regulations around those are what make it most difficult.
I think the SEC is taking a very thoughtful approach on it.
Well, right. The CFTC, I just wanted to point that out to the audience, the CFTC, and that also has to do with the clients that the CFTC serves versus the SEC, right?
Yeah, and I listen, this is a new product. We just got futures in it. We're just getting some standardization. So I understand the regulators saying, let's take a beat. Let's take a beat and make sure that we get this right. And I thought the meeting was a week or two ago in front of the Senate Banking Committee was a home run. It's exactly what the regulators should have done. They said, listen, this is a new technology. We recognize that it's innovative and we want to support it. But at the same time, we want to make sure the general public isn't getting defrauded, that we aren't, messing with the capital markets, all the things that they should be doing. So I think it's going to take a bit, and I think that's probably right to take a bit in terms of a cryptocurrency-backed ETF.
Speaking of ETFs, and you had a global macro fund, and you were alive in 2008, 2009. What do you think about this rise of passive investment vehicles like ETFs, the culling really of or the challenges that active managers have had, all these years, right? And the success that people have had using these systemic trading strategies and going short volatility. There are a lot of questions wrapped up in that sort of, bomb of a statement. But, what do you think? We finally got a spike in volatility recently for the first time in forever. What is your general market outlook? And then we can, kind of loop that back into Bitcoin.
Sure. All right. Well, yeah. So there's a lot to unpack there. Let's start with the passive investment theme, and I'll be controversial here. It's a complete misnomer, and you're kidding yourself if you think you're being passively invested. If you are investing in an index, you are making an active decision to buy these 500 stocks. You're making an active decision to not buy any other 500 stocks.
You, as the investor, buying the ETF, but there's no one actually actively managing that. There are systemic.
Well, but there is an index committee that says these are the 500 stocks that we believe should be out there.
Right.
And so the index committee has become your portfolio manager. So don't think of this as, it's not passive where this works the best and it never goes down, because that's what people think. They think, oh, well, active managers can't do anything, I'm just going to passive. And you are making an active decision to say, I am only going to buy these stocks. So I find the whole passive active argument to be
the nomenclature.
It's silly. It's silly. You're not passive investing. You are making an active choice.
Okay, so then let's talk about this, and you know more about this than I do because you've actually managed the fund. If I were managing my money and I had a certain amount of it and I made the active decision to put it into an ETF, that ETF, first of all, there's also a calculation. There's a difference between actually being invested in the actual underlying asset or what the ETF is buying in. But then from what I understand, these ETFs have systemic trading strategies that kick in certain moments, which would be very different than if you're actually managing the asset yourself actively. Mm-hmm. That has raised a lot of concerns over the last few years, because there are many people that think that puts the market as a whole at risk, because in the case of a liquidation, it just becomes a mass herd effect in a way that you wouldn't normally have otherwise.
Yeah.
Something analogous to 1987?
Yeah, we've been saying it since 87, right?
Yeah, but you think it's overrated?
No, I think it exists. I think it's never been a concern of mine that it's going to be a system-wide issue, right? The system-wide issues, the systemic risks that we had in 2007, 2008 had nothing to do with algorithms, had nothing to do with the fact that people got over-leveraged and bought stuff they shouldn't have bought. I mean, and we're all to blame for it, right? I'm not blaming anybody. Everybody should take blame for that.
Some more than others.
Well, no, actually, you know what? Listen, some people were selling a product that other people wanted, and we're all complicit in it. But that's probably for another podcast. But in terms of that, what you get is you get these short-term dislocations. And we saw it very recently with the VIX, right? Volatility spiked up. Now, the market started to sell off not because of volatility. The market started to sell off because we got a hot jobs print and we got a hot wage print, right? And so people had mispriced where the Fed was. And where you misprice interest rates, that filters into the equity market. And so we had to reprice equities. That sell-off was exacerbated because you have had a proliferation of short vol traders, not just ETFs, but short vol traders in the market. It's one of the biggest kind of stealth strategies out there. And so when they had to unwind that caused the market to unwind a little bit more. So the market's prone to that. The market has always been prone to that.
What is your outlook for and by the way, I hate, in some ways I kind of ask this question. It's a shitty question. Because you're not a freaking oracle, you know what I mean? But there's something, listen, right. But you work in media, right. So these questions. I hardly ask them. It's certainly the extent to which I ask a question like this on this show is minimal compared to what the media does. So, but are you concerned that, as this expansion or recovery or in equities goes on for longer and longer, that it just becomes more and more dangerous to be in anything other than cash? That's my way of basically saying going to the bunker.
Right,
scared.
Right. So
how do I unleverage?
All right. So I will tell you at some point, in the next 5 to 10 years, it's my view that we have another bear market, and it could be fairly nasty bear market. I don't think we're there today. I think the way that I look at it is, and I say, okay, we have an improving economy. We have relative peace around the world. That might change. We have a relatively stable dollar, although it's weakened a bit recently. So, all the signs out there is that we're having economic improvement. Bear markets generally don't start when things are improving. When bear markets start, the risks out there are, okay, is the Fed too far behind the curve? I don't think we can say that yet, right? People have been running around with their hair on fire, inflation's coming. Well, we're at 2.1 on the CPI. A year ago, we were having discussion about maybe raising the inflation target to 4% because we couldn't create any inflation. So I think we need to take it in perspective.
You say people are saying inflation's coming. That's a recently people are concerned that inflation is coming.
Yeah, that's been it's been probably about
I've heard that more.
Yeah, so I mean, it's been, if you look at the rise in interest rates, about 2/3 of it are real rates, which are based on the economy, right? The real rate of, and then the other 1/3 is inflation expectations. That has been rising. It's not out of control. If I look at inflation globally, it's not out of control yet. I can certainly come up with a scenario where it gets out of control, but we're not there today. And so that's my concern, is that if I'm looking for red flags, I'm looking for a Federal Reserve that's too aggressive or gets caught behind the curve. Obviously, the exogenous events like an incident in North Korea or any other kind of hotspot around the world. I would be concerned about protectionism. We're certainly trending in that area. Those are kind of the events to me that would start to signal, hey, you know what? Why don't I take some off the table? In the longer run, we have a demographic issue in that if you look at, the baby boomers.
Structural demographics.
Yeah, the baby boomers are going to start taking money out of the market, right? And it's part of the reason why crypto actually really appealed to me. Because if I look at...
Interesting.
Yeah, if I look back and say, okay, let's look at the investment grids.
Like let the old people get in the boat.
Yeah, well...
I'm jumping in I'm jumping in these teenagers.
With the millennials. But think about it, right? So you look at the investment grades, Warren Buffett, guys like that, right? They all came up during a period of time, and clearly they're great investors, and clearly they're smarter than the average bear, but they also had this massive tailwind of baby boomers every month saving for retirement.
Right.
Every month, right?
I see what you're saying.
And so that's ending. The baby boomers are going to start taking that money out and start doing something with it. So you say, great, well, who's the next class in there? My generation isn't. My generation is just getting by, right? The millennials, they're the ones. Now, the bull case for the equity markets is that the millennials are going to start saving just like the baby boomers. However, the millennials have not shown that propensity yet. They want to be in cryptocurrency. They want to be in that. So if I look at my career, I'm 46 now, 47. If I look at the next 10 years of my career, where's the tailwind? Digital currencies, digital assets.
You brought up a lot of very interesting points. I'm going to enunciate them right now so I try not to forget them. But one thing deals with inflation. I've always been apt to believe far more that we're at risk of deflation, and that feeds into the structural demographics and the debt, the private levels debt. I think that the crisis of 2008 and the prior ones, everything that basically since 1971 where we really saw a ramp up in total debt, I think that remains a major outstanding issue, and I think it's a driver in part of the wealth and income gap. And I think all those things feed into the deflationary argument. This is really interesting, this point you bring up about millennials, the difference between millennials and older demographics and their adoption of cryptocurrencies. I think there's something really real there and true. And I think it's probably something that I would, not probably, most certainly something that I would like to delve in deeper to on this show, which is this phenomenon that I've witnessed, which is that my demographic and younger, my age and younger, we're not so enamored with the idea of, stocks, bonds, equity, get my financial advisor. It just feels lame. And it also feels, for me personally, I don't want to trust this guy who doesn't really know much about anything necessarily to just take my money and invest it. And there's also a change in terms of, I think there's a moral, ethical sort of value system set change going on in our society where people have a different sense of what they want the future to look like, and they're looking to find ways to invest in that future. So in some ways, I think cryptocurrencies is a desire for, quote, millennials, whatever you want to call it, to express their view of the future financially, to invest in accordance with sort of how they see the future unfolding. I do think, though, it's interesting to ask and to sort of wonder to what extent that desire is aligned with the underlying reality of these assets and their value propositions. And that's why I've done a bunch of these shows. For me personally, where I'm most concerned about the value of cryptocurrencies, I started off thinking, being like, well, Bitcoin, I really don't see the value in this. And I see the value in Ethereum and the utility protocols. But as I've done more research and thought about it more and interviewed people like Chris Burniske, I actually see the case for Bitcoin as a store of value, based on the network effect and based on some other factors. In the case of Ethereum, that is the thing that I remain the most bearish on. And the reason I'm most bearish on Ethereum is not because I'm certain that it's not going to work or something. It's because I think it's the most at risk to being disrupted by the type of technological innovations that we've talked about here today. I think if a lot of these dApps, and this goes back to our point about the problem of scalability, and like if, proof of stake on a blockchain can work and they can scale it and all these things, then that's not going to be an issue. But I do think it's interesting to focus on a lot of really interesting use cases in dApps, which ones might have the sort of most promising teams. And then if there can come a different utility protocol underneath that can scale the network, then they could scale with it. I mean, but that's just sort of my, my coming at this from the outside.
I mean, I think that's a fair criticism that, because there are some competitors to Ethereum, and they have gained quite a bit of traction.
Are there any that you're looking at?
Well, yeah. So, I mean, if you look at EOS and NEO, even Ethereum Classic for that matter, Cosmos, the one that I mentioned, you can do smart contracts there. So there are definitely smart contract protocols out there that are challengers. It then comes down to, okay, what's going to be built on top of it, right? And just like Bitcoin has a massive lead on the payments area, store of value network effect, Ethereum at this point has a massive lead. That doesn't mean it can't be disrupted, but you look at what Joe Lubin's doing at Consensus over in Brooklyn, right? I think he's got 600 or 700 people working 24 hours a day building something on Ethereum, right? So the bull case for me there is, okay, I don't know what's going to be built on it, but I do know that if only 10% of the stuff they're working on comes out, there's going to be the next Amazon or Facebook in there.
Although they're being built modularly, so they would be able to build these dApps on a different protocol.
No question. There's no question.
So that really gets to another question, which is how do you keep your ear to the grindstone, let's say, or whatever that expression is. It ear to the grindstone?
No, it's nose to the grindstone and ear to the ground. Yeah.
No one uses their nose anymore to collect information.
Only dogs.
So how do you stay on the beat or whatever,
Right.
How do you because it might not be something that you're aware of, something that's come out recently or that's about to come out that hasn't even come out yet, that's going to really be the winner in this sort of arms race.
Yeah. That's my job every day, right, is to be on the lookout for the next thing and what's happening out there. So, I certainly, between me and my team, we're constantly on the road, going to conferences, meeting with new teams, meeting with new ICOs. We use our network. We tap really smart people and ask them what they see going on. And, it goes back to, again, I am making a bet on the ecosystem, the digital currency, digital asset ecosystem. I came up in the 90s during the internet bubble. And, like I said, half of those companies don't exist today. And some of them were actually, I was saying to my wife the other day, everybody jokes about pets.com.
Everyone talks about pets.com. Why is that?
Because it was the poster child for internet excess, right?
How much was it worth at its peak?
Oh, geez, I forget. But it was the poster child for the bubble, right? Because it went to zero. But here's what's interesting. Their business model was selling pet food online.
Yeah, they were just too early.
They were 30 years too early. Chewy got bought out for $1 billion last year, right? So I look at that and say, you might have a great idea today in crypto. You might be 30 years too early. Some of these projects might be 30 years too early. And so the best part to me, from an investor and a trader perspective, is this is like venture capital investing, but I have instant liquidity. So if I take a typical venture capital mindset and say, okay, I'm going to invest in 100 companies, 90 of them are going to go to zero, 10 are going to be my huge winners, okay? That's kind of how venture capitalists look at it. Well, in this space, I can say, yeah, I'm going to buy 100 different cryptocurrencies. In 5 years, 90 of them might go to zero, but in the meantime, I can extract value from them. I can get 50 cents on the dollar instead of zero. So I think, this model for venture capital investing is much better than anything that we've seen before. I went a little astray from your original question.
No, not at all. I moderated a panel last week for Celsius, and that's Alex Mashinsky's company. And on the panel, and Alex said this before, and he's not the only one. A lot of people say this, that we haven't had yet, and we need to have the Netscape moment, right? The killer app. And my sort of question to him when he said that was, again, it brings us back to the question of scalability. Can you have a Netscape moment with a network that has such a low level of throughput? And, I don't know the answer to that. My guess would be that you can't. No. And you think you can?
No.
Okay.
Today you can't.
Right,
look at CryptoKitties.
Right.
And,
exactly.
It slowed down the entire Ethereum network, and that was the killer app, right?
Exactly.
So I think I look at that and say, no, we clearly need to work on scalability. We clearly need to get the throughput out there. There are some people out there that are working on it. I think will solve that problem. But if you came up with the next Facebook today, you'd crash almost every single one of these blockchains.
Well, I think for sure, I mean, where I fall on this, and the reason why I've been covering, well, one reason I've been covering is obviously the same reason I'm sure you know, is that there's massive interest.
Right.
Like, that's why everyone's covering it, right? I mean, I just see the numbers on my audience when I talk about this. And it's an interesting space for me to get into because I have a background in tech and I also have a background in finance. But I think ultimately, separate from that is actually the fact that I do think that there's something really powerful here, which is the disintermediation of the data layer, right? I mean, doing for data storage, communication, and processing, as I've said before, what the Internet suite of protocols did for communication. And that is what we need. And, you know, we've covered stuff on this show before with people like Jeffrey Rosen on constitutional law and how do you sort of move into this future with these technologies that are intermediating experience. How do you get to a place where you can have safe experiences when they're happening on someone else's database that they control? You know, like that's really scary stuff. So I think, you know, I certainly hope that a company will solve this problem. I'm looking for that. It's something that we've covered on the show from different perspectives. But yeah, I mean, I definitely think it's something to focus on. I don't know the answer, but yeah, I think it's really interesting. Do you think that central bankers are going to be out of a job? Because that's what we're kind of getting at here.
Yeah. Is this live now? I mean,
it's not live, but it's going to go out.
Yeah.
It's going to go out.
So people are going to listen. Okay.
It's going to go out. This is live to tape.
No.
This is like David Letterman.
Right. So probably not in my lifetime.
Yeah.
I don't think so. I mean, I do think that there's going to be a global digital currency.
666, Mark of the Beast.
Yeah, I mean, I think I don't
RFID
think
chip.
You know, there's too much. Yeah, exactly. There's too much. I think it would take too much of a political upheaval to put a central banker out of business.
I also think that people are really underestimating the power of governments.
Right,
I think that this community really, really underestimates that. The really bullish sort of the hodlers or whatever you want to call them.
There's no question that this technology can disrupt central banks.
Yeah.
So to that, I would say yes,
scale,
absolutely, this can disrupt central banks. But you got to go through a lot. And listen, you know, I don't, you know,
well, governments don't want to give up seniorage rights. They don't want to give up the right to
give up any of that. Right?
They don't want to give up the right to print their own money. Why would they do that?
Exactly. How do they tax it?
And they have all the guns.
Those things, right?
They have all the guns. You know?
Exactly. So yeah, I mean, listen, if you're buying Bitcoin and thinking that, you know, the global political system is going to disintegrate at any time soon, I also think you should probably be buying some guns and probably some canned goods too, because we've got other issues, you know. And the point is, I do think that this technology can survive without disrupting central banks. There's plenty of use cases for this.
Brian, it was great having you on the show, man. Thanks for coming on.
My pleasure. Thanks for having me.
Thank you.
Enjoyed the discussion.
And that was my episode with Brian Kelly. I want to thank Brian for being on my program. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforcespod.com. Join the conversation through Facebook, Twitter, and Instagram at hiddenforcespod, or send me an email at dk@hiddenforcespod.com. Thanks for listening. We'll see you next week.